Welcome to Section 1, Introduction and Basics. This is lecture number 4, What is Elliott-Wave Principle? According to Wikipedia, Ralph Nelson Elliott was an American accountant and author whose study of stock market data led him to develop the wave principle, a form of technical analysis that identifies trends in the financial markets. He proposed that market prices unfold in specific patterns, which practitioners today call Elliott waves. So basically, in the 1930s, this gentleman in front of you, Mr. Ralph Nelson Elliott, discovered that the stock market prices trend and reverse in recognizable patterns. The patterns that he discerned are repetitive in form, but not necessarily in time or amplitude. Elliott isolated 5 such patterns or waves that recur in market price data. He named, defined, and illustrated these patterns and their variations. He then described how they link together to form larger versions of themselves, how they in turn link to form the same patterns of the next larger size, and so on, producing a structured progression. He called this phenomenon the wave principle. So at that time, a few people believed in his theory and practiced the Elliott wave principle on price charts, but mostly this theory remained hidden in libraries and Wall Street. Then comes Mr. Robert Proctor Jr., this gentleman in front of you. Mr. Robert Proctor Jr. introduced R.N. Elliott's works and his findings to the modern world and the Wall Street, which were really forgotten and kept as hidden. So according to Wikipedia, Robert Proctor Jr. is an American author and stock market analyst known for his financial forecasts using the Elliott wave principle. Proctor is an author and co-author of 14 books, and editor of 2 books, and his book, Conquer the Crash, was a New York Times bestseller in 2002. He also has published monthly financial commentary in the newsletter The Elliott Wave Theorist since 1979. And is the founder of Elliott Wave International and New Classics Library. His website is elliottwave.com. So from all these guys, all these great guys, what we got is this book, The Elliott Wave Principle, Key to Market Behavior. Mr. Robert Proctor co-authored this book with Mr. A.J. Frost, and it's still a Wall Street classic, and this is the primary book on Elliott Wave Principle, and this is also our primary course book. I advise you to buy the hard copy from the market or from the website, and if you are comfortable with the soft copy, you can get it free of cost, originally $29 value. You can get it free of cost at this special link, all right? You can just type in this link in your browser and you will get this book in front of you. What this book teaches us is the specific shapes, specific patterns that the price unfolds in, all right? It doesn't really matter what time frame you are looking at, what market you are watching, what trend you are looking at, either bullish trend or a bearish trend or sideways, the price is always going to unfold in form of Elliott wave patterns, right? That we are going to study. We shall study about each pattern in detail in coming sections, right? Let me just give you a basic look of these patterns here one by one. So these are only 5 basic patterns, and let's start with an impulse wave, which is the most basic pattern, by the way, and our area of interest, because all other patterns are linked with this impulse wave pattern. Let's call these patterns the waves, right? I'm just showing you here the basic waves, and they are divided into 2 main types: the trend or motive waves and the counter trend or corrective waves, right? So as on this slide, the impulse and the diagonal, these 2 wave patterns, are the motive waves or the trending waves, and the zigzag, flat, triangle, and the combination of these 3 are corrective waves or counter trend waves, right, against the main trend, or the hurdles in path of main trend, right? So any Elliott wave pattern, when completes, can reverse the price trend that may or may not reach the start of that pattern. For example, this pattern is called as an impulse wave, right? When completed at this point, can reverse the price to the downside. In this case, the reversal, this new trend to the downside, it may or may not reach the start of this impulse wave, all right? Also, in the case, if you don't know about the terminologies, let me tell you the terminology of bullish and bearish. When the price goes up, this is a bullish trend, right? When the price goes down, this is a bearish trend. Bullish, bearish, right? So let's start with an impulse wave. Well, this is an idealized form, idealized shape of an impulse wave. This wave that looks like a staircase, it has 5 waves in it, 5 legs in it, 1, 2, 3, 4, 5. This is a trending wave. It moves in the direction of main trend, all right, and it is usually very fast and sharp wave. So when the trend is to the upside, you see an impulse like this, and when the trend is to the downside, you see an impulse like this, right? So it really doesn't matter what trend you are looking at. In a bullish trend, the impulse goes up. In the bearish trend, the impulse goes down. But the shape, the form, the rules, the guidelines for an impulse wave, they remain the same. All right. 1, 2, 3, 4, 5. All right. And also for the motive waves, the impulse and the diagonal, we use the numbers to label these waves as 1, 2, 3, 4, 5. And for the corrective waves, the zigzag, flat, and triangle, we use the alphabets A, B, C, D, E to label the waves. All right. So it really doesn't matter what trend you are looking at. In a bullish trend, the impulse goes up. In a bearish trend, it is just upside down. They do not change in bullish or bearish markets. So this is an impulse wave. Let me show you on the price chart of Euro USD how it looks like on a real-time price chart. This is the price chart of Euro USD. The time frame is daily, right? We are looking at what is Elliott wave principle example, right? So this is an impulse wave here and here. I told you impulse wave is a very sharp wave, and here we are only looking at the basic patterns, not the details. All right, so we have 1, 2, 3, 4, 5. Why this wave is too big, we are going to study in the next sections. All right, this is an impulse wave to the downside. Here is an impulse wave to the upside, right? You can see clear 5 waves here. 1, 2, 3, 4, 5. Clear 5 waves here. 1, 2, 3, 4, 5. All right, examples of impulse wave on a real-time price chart of Euro USD on daily time frame. If you want to see these impulse wave on your platform, this impulse wave started in May 2014 and ended in March 2015. this impulse wave started in December 2016 and ended in February 2018. Okay, so these are the examples of impulse waves. Now let's talk about the diagonal pattern. When the trend is to the upside, the diagonal appears like this. This wedge shape pattern, it's this 1, 2, 3, 4, 5, right? This is the diagonal. 1, 2, 3, 4, 5. All right. The diagonal is always enclosed in these two trend lines, the 1, 3 trend line and the 2, 4 trend line. All right. And when the market is going down, the diagonal looks like this. Just upside down and nothing else. All right. And one more thing, that by default, we put the wave label at the end of the wave. All right. This one is for this wave, this move right here, this one. All right. This is the first wave. This to the downside is the second wave. Well, we could write the labels like this 1 and 2, right? This is another option, 3, okay? But that does not look good and that interferes with the waves inside, okay? So by default, these labels are put at the end of waves, right? This first wave ended here, so we put 1 here. The second wave ended here, so we put 2 here, and so on, all right? So that's it. This is how a diagonal looks like. Let me show you diagonal, this wedge-shaped pattern on the real-time price chart. So this is again the price chart of Euro USD. This is a diagonal. You see this wedge shape, right? This is a diagonal. Here we have a diagonal. 1, 2, 3, 4, 5. 5 waves in a diagonal, all right? And as I said, when the pattern is complete, you can expect a reversal in the trend that may or may not reach the start of the pattern, all right? This diagonal initiated at this level right here. So this reversal, it surpassed this start of the diagonal, all right? This diagonal reversed the price to the upside, which again surpassed the start of the diagonal, which is here, right? So let's see how a zigzag looks like. So as I said, this zigzag, flat, and the triangle, they are counter trend moves. So when the price is going to the upside, the zigzag will unfold in the downward direction, all right? So in the bullish trend, in the upward trend, the zigzag looks like this, only 3 waves. And as I said, these corrections are labeled as A, B, C, all right? This is A, this is B, and this is C. And again, when the main trend is to the downside, the price is going down, the zigzag is going to be in upward direction, right? This is a zigzag in a bearish market, A, B, C, right? So this is a zigzag as a line diagram. Let me show you a zigzag on that price chart of Euro USD. We have a zigzag, right? The trend was to the upside. You can see this move goes up. The zigzag is to the downside. After the zigzag completes, this ABC is completed here. The market reverses to the upside again, right? So this is a zigzag. This is a zigzag, ABC. You can see price was going up. The main trend is to the upside. And you see a zigzag here. After the zigzag finishes here, the price reverses to the upside, and this price goes beyond the start of this zigzag, right? Unlike here, this move to the upside could not go as high as the start of this zigzag here, right? Like this, all right? So let's have a look at flat. This is a flat in front of you. Wave A, B, and C. That's it. When the market is going up, this is a flat that goes down. All right. When the market is going down, the flat goes up like this. 3 waves, A, B, C, right? Just like a zigzag. The only difference is in their structure, their internal subwaves, all right, that we are going to study in next sections. Okay. So this is a flat on line diagram. Let's have a look at its labeling. This is wave A, this is wave B, this is wave C. This is wave A, wave B, and wave C. Right? Now let's have a look at real-time flat. This is a flat here. This impulse wave, 1, 2, 3, 4, 5, it has a flat here. There was a zigzag in wave 4, if you noticed. This is wave 4, right? If this is an impulse wave, this is wave 4, and wave 4 was a zigzag. Wave 4 unfolded as a zigzag. This wave 2 unfolded as a flat, right? We have ABC here, okay? So this is a flat. Let's have a look at another pattern, which is a triangle. When the market is going up, the triangle is to the downside. This is first leg, this is second leg, third, fourth, and fifth. All right. The triangle has 5 waves in it, or 5 legs in it, right? The triangle is a sideways pattern, means the average price remains the same. All right. It's down, up, down, up, down. And when the market is going to the downside, the direction of the triangle is to the upside. A, B, C, D, E, right? As I said, these are corrective wave patterns, and we label them as alphabets. So this is labeled as this, and this one is labeled as this. All right. So this is a triangle, a sideways pattern. The average price, as I said, remains almost the same. All right. Let's have a look at real-time triangle. So this in front of you is a real-time triangle that initiated at this point. We have A, B, C, D, and E. All right. Also, the triangle is enclosed into trend lines, just like an ending diagonal. All right. This is AC trend line. This is BD trend line. So that's a triangle. When finished, reverses the price in another direction. All right. So these are the Elliott wave patterns. These are the basic Elliott wave patterns. We are surely going to study these patterns into details and also their variations in the coming sections. All right. In this lecture, my goal was to give you a basic introduction of these Elliott wave patterns, right? Let's talk a little bit about the scale. All right. This in front of you is a price chart of pound US dollar, right? British pound versus US dollar forex currency pair, and the time frame is daily. We are having a look at the right scale and compression. Okay. For the price charts, what is the best scale and what is the best size of these bars and what is the compression level that you should use? Well, I can tell you what I use and what most elliotticians out there they use, right? And you can use whatever suits you. And let me tell you some pros and cons of what I use. All right. At this level of these
bars. These are called the bars, right? Not the candlestick or line chart. So at this level of compression, the bars are clear to you, but you have certainly small amount of data in front of you, right? And also these waves are not countable. All right, you cannot count these waves clearly at this level. When you zoom out a little bit like this, it is again not countable, but the amount of data has increased, right? When you compress a little bit more, well, this is my favorite. This is the best one because I can count the waves. Even at this level, you can count 1, 2, 3, 4, 5. This is an impulse wave. You can count as A, B, C, a zigzag, right? So the waves are countable. Also, the amount of data has certainly increased, right? So this is the compression level that I use for my price charts, okay? You can use whatever suits you, okay? Let's now go to another thing that I wanted to show you. Let's go back to this level of compression. This is bar chart, right? These guys here are bars, right? Every line, these vertical lines is a bar, a price bar. This is candlestick chart, right? You can see these are price candles, okay? What I am going to show you is very interesting. At this level, this chart, specifically in this pattern, this ABC pattern, can you tell me the bottom here? What is the low here? Well, this point, of course, this is certainly the bottom. You can see this line, right? This is the bottom, not this one, right? This is above this low, okay? So this is the bottom here. As soon as I switch to line chart, let me first mark this as bottom, right? This one is the bottom. As soon as we switch to line chart, you can see this is no more the bottom. This is no more the low, I mean, right? This is a low, right? So this is a big difference, right? Big difference. This is the low on line chart. This is the low on candlestick or even bar chart, right? So I wanted to give you a warning not to use the line chart ever if you want to count the waves correctly, all right? If you use the line chart, you may end up calling this as the bottom instead of this as a bottom, right? This one is the real bottom. You have ABC. If this is a line chart, where is the ABC now, right? You have only one wave to the upside. So that's the second thing I wanted to tell you. That's it about the basic introduction of the Elliott wave principle. Obviously, that's not it. The journey has actually just begun. Thanks for the attendance. Until next class. Welcome to section 2, impulse waves. This is lecture 1, what is an impulse wave? By definition, a set of 5 non-overlapping waves is an impulse wave. 3 waves in the direction of main trend, 2 waves against the direction of main trend. Just like this one. This in front of you in magenta color is an idealized form of an impulse wave. We have 1, 2, 3, 4, 5 waves, right? 5 non-overlapping waves, right? And wave 1, 3, and 5, these 3 waves, they move in the direction of main trend.
wave 2 and wave 4, these two waves move against the direction of main trend. Well, impulse wave is very first pattern that we learn in the Elliott wave principle. In my opinion, impulse wave is the most important wave pattern to learn for analysis as well as trading purposes. Because once you have successfully spotted an impulse wave on price chart, the previous as well as upcoming price action starts to make sense even if it didn't make any sense before. Let's see how an ideal impulse wave looks like in bullish and bearish markets. On left hand side, I will show you the line diagram of an impulse wave in bullish trend, means when the price goes up, right? And on the right hand side, I will show you line diagram of an impulse wave in a bearish market, means when the price is going down. So this is an ideal impulse wave in a bullish market, right? When the price is going up. A set of 5 non-overlapping waves. This is an impulse wave in front of you. This is one impulse wave, all right? It consists of 5 waves and it's one single impulse wave in front of you in a bullish market. These sub-waves, they should not be overlapping just like this one. This is not an impulse wave, right? These overlapping waves, they are not characteristic of an impulse wave. This one at the left hand side is an impulse wave, right? Now, this is an ideal impulse wave in a bearish market when the trend is to the downside, right? This is same as this one, but just upside down. And how to label it? Well, we put their numbers at the end of each subwave, just like this one. This is wave 1, this is wave 2, this is wave 3, this is wave 4, and this is wave 5, right? So this is a bullish impulse wave, this is bearish impulse wave, this is wave 1, this is wave 2, this is wave 3, this is wave 4, this is wave 5. After the completion of an impulse wave, we can expect a reversal in trend in opposite direction, either temporary or permanent reversal. That depends on the degree and time frame, right? So after this impulse wave, you will see a trend to the downside, and after this bearish impulse wave, we are expecting a trend reversal to the upside, right? Let's now talk about the characteristics of an impulse wave. Previously, we have learned that there are 5 primary wave patterns described in the Elliott wave principle book by Frost and Proctor, and these patterns are impulse wave, diagonal, zigzag, flat, and triangle. Well, an impulse wave is the fastest wave among all. Means it travels a lot of vertical distance in very short amount of time, which is horizontal scale. Number 2 is it consists of 5 subwaves labeled as 1, 2, 3, 4, 5, as we have just seen on the whiteboard. Number 3 is regarding the subwaves, there are 3 rules of Elliott that we shall study in more detail in next lecture. So these rules are, number 1, wave 2 cannot go beyond the start of wave 1. This is the start of wave 1. This wave 2 cannot go beyond the start of wave 1. All right. Similarly, here in a bearish market, this wave 2 cannot go beyond the start of wave 1, which is here. Rule number 2 is wave 3 can never be the shortest wave among waves 1, 3, and 5. This wave 3, it cannot be the shortest wave of waves 1, 3, and 5, right? It may not be the longest, but it can never be the shortest. When you compare the sizes, the vertical sizes, the vertical lengths of wave 1, 3, and 5. Wave 3 can never be the shortest. Rule number 3 is wave 4 cannot end in the price territory of wave 1. This is wave 4. This is the end of wave 4. This wave 4 cannot end in the price territory of wave 1. This is the price territory of wave 1, right? This wave 4 cannot end here. That's wrong. Similarly, in a bearish market, this wave 4 cannot end in the price territory of wave 1, which is here, right? So, characteristic number 4. Wave 1 and wave 5 are motive waves, means they unfold as either an impulse wave at one smaller degree or as a diagonal. This diagonal we shall study in the next section. Characteristic number 5 is wave 3 of an impulse wave is always an impulse wave subdivided at one smaller degree. It can never be a diagonal, right? This is related to the science of fractals that we shall study in the next lecture. Number 6 is wave 3 of an impulse wave is most often the fastest and sharpest price movement and is often accompanied by a price gap. All right? So price gaps, they most often appear in wave 3 or wave 3 of 3. Characteristic number 7 is wave 2 is correction of wave 1 and wave 4 is correction of wave 3. Number 8 is an impulse wave is almost always clear and have clear subdivisions, and it's easy to spot. If it's not clear but confusing, then maybe it's not an impulse wave but something else. Number 9 is only a few times an impulse wave is slower than what it should normally be. Often wave 1 shows this characteristic when a big trend has finished, and this wave 1 is starting a new trend in other direction, and wave 5 shows this characteristic when the big trend is ending. Characteristic number 10, the last but not least, generally speaking, an impulse wave is the best wave to trade because after completion of any pattern, there is high probability that the next trend starts with an impulse wave, and another reason is that an impulse wave completes its course very quickly, unlike other Elliott wave patterns. So that's it about the definition, the diagram, and the characteristics of an impulse wave. Now let's have a look at real-time examples of impulse waves on price charts of different instruments with different time frames. This is price chart of Forex currency pair Euro USD, and the time frame is weekly. Euro USD is, by the way, the most traded Forex currency pair in the world. What is an impulse wave? Example number 1. Well, on this price chart of Euro USD, from this low that formed in January 2017 and this high that formed in February 2018, I see a clear impulse wave here. Can you see it? Can you see 5 non-overlapping waves here? Yes, you can see it. It's obvious and very clear, right? That's it. This is an impulse wave that consists of 5 subwaves, right? Up, down, up, down, up. That's an impulse wave. And how to label it? That's it. Wave 1, 2, 3, 4, 5. perfect, and a textbook example of an impulse wave on price chart of Euro USD on weekly time frame, right? And after the completion of an impulse wave, we can expect a reversal in the trend, either temporary or permanent. That depends on the degree, and that's not our topic here, right? We are not discussing the past data. We are not discussing about the future. We are only discussing this impulse wave. You can see clearly this wave 2 did not go beyond the start of wave 1, which is here. This wave 3 is not the shortest wave of waves 1, 3, and 5. And this wave 4 did not end in the price territory of wave 1, which is here, right? So 3 rules of Elliott hold true here. And as a result, we get this textbook example of an impulse wave. Let's now go to another example of an impulse wave. This is price chart of American wheat, and the time frame is 1 hour. We are having a look at this price data from 26th of June 2020 until 16th of July 2020, right? From this low until this high. This is what is an impulse wave, example number 2 here, right? So do you see an impulse wave here? Well, it's very clear. It's clear as a day. You can see here, right? Up, down, up, down, up. Clear 5 subwaves that make up an impulse wave to the upside on 1 hour chart of wheat, right? How to label it? Like this. This is wave 1, wave 2, wave 3, wave 4, wave 5, right? After the completion of these 5 waves, we can expect trend reversal, right? So this is another textbook example of an impulse wave on price chart of wheat on 1 hour time frame. Let's have a look at another example now. This is price chart of crude oil. The time frame is daily. This is what is an impulse wave, example number 3 here, right? We are having a look at this price data from 8th of January 2020 until 21st of April 2020, right? Do you see an impulse wave here? Yes, well, that's obvious. This is a move to the downside, a move to the upside, a move to the downside, a move to the upside, a move to the downside, right? In this lecture, please ignore these subdivisions here, all right? This down, up, down, up, down. Please ignore them. This is topic for the next lecture, all right? So these are 5 waves here, and you can see a clear price gap here. You see, this is a price gap. We have studied that the price gap will often appear in wave 3 of an impulse wave. This is wave 3 of an impulse wave, right? More specifically, it's wave 3 of an impulse wave, right? And how to label it? Like this: wave 1, 2, 3, 4, 5. That's it. A beautiful textbook example of an impulse wave on price chart of crude oil on daily time frame. That's it. After the completion of impulse wave, we can expect a trend reversal, right? In the opposite direction, okay? Because at the wave 5, this impulse wave ends. So that's all about the impulse waves. I hope you get the idea of how an impulse wave really looks like. I am telling again that this is the wave pattern that we should target to trade. We should always look to ride an impulse wave because that's where the most amount of profits in shortest amount of time is, all right? So impulse wave is really very important wave pattern in the Elliott wave principle, maybe the most important wave pattern of all. Thanks for your attendance. Until next time. Welcome to section 2, impulse waves. This is lecture 2, the science of fractals. In the previous lecture, we have learned about a simple 5-wave impulse wave, that is a motive wave, which simply means it moves in the direction of larger or main trend, right? In this lecture, we are going to dig deep into the same topic of impulse waves and see how it looks like in more detail. Let's say this is a simple impulse wave on a weekly time frame. By the way, do not confuse the length of this first wave versus third wave versus fifth wave. Okay, do not confuse with that. We will discuss it later. So this is a 5-wave simple impulse wave, right? If you zoom this first wave in and go to smaller time frame, maybe daily time frame or intraday, like 1 hour, 30-minute time frame, my question to you is, are you going to see a straight line there like this? Or maybe a bigger line on smaller time frame? Well, the short answer is no, of course. And the answer may surprise you actually, because what you will see on smaller time frame is another look-alike of this big impulse wave, which is an impulse wave on smaller degree. So each motive waves here in this impulse wave, the motive waves are wave 1, 3, and 5. So each motive wave is subdivided into other motive waves. Let me show you how it looks like on smaller time frame. Let's use another color for that. So this first wave looks like this. Small 5 waves in the first wave, then wave 2, then small 5 waves in wave 3, then wave 4, and then small 5 waves in fifth wave. This wave 2 and wave 4 are corrective waves, so we will discuss them later. We are only discussing these motive waves, waves 1, 3, and 5. Now similarly, if you zoom in this third wave, you see you are going to see 5 smaller waves in them. Same is the case with the fifth wave. Well, if you further zoom in this first wave, you are again going to see smaller impulse waves in these 3 motive waves, waves 1, 3, and 5. You are again going to see smaller versions there, 1, 2, 3, 4, 5, 1, 2, 3, 4, 5, right? Just like this, 1, 2, 3, 4, 5, 1, 2, 3, 4, 5, 1, 2, 3, 4, 5. All I have drawn here is this first wave. So this is the beauty of fractals. This is the beauty of Elliott wave principle, right? You are seeing the impulse waves inside the impulse waves. Isn't it amazing? This nature of waves is called as fractals. The waves, inside the waves, inside the waves, and so on, until you run out of time frames, of course. So for the convenience, we shall call this wave a detailed impulse wave, okay? By the way, we see these fractals all around us in our daily lives. For example, trees are fractals. The branches join together to make bigger versions of branches. Then the process repeats, and finally you see a big tree in front of you. Leaves and flowers are fractals. You see this big leaf. If you zoom in and in the trading language you go to smaller time frame, you are going to see a leaf there, a small leaf there, see? And this small leaf, it looks exactly the same as this big leaf, isn't it? And guess what?
you go to even a small degree, you zoom it in, and you're going to see this small leaf there, which looks exactly same to this leaf, which looks exactly the same to this leaf, and maybe these leaves are parts of one branch, a bigger branch, or maybe a big tree that looks exactly the same like this. This is the beauty of nature. Lightning is fractal. You see these small branches there? They subdivide, right? This is fractal. This is natural. So, back to the waves. Let's see how we label these small waves. It's exactly the same as the big waves, by the way. Let me show you practically. This is one impulse wave in more detail, right, on smaller time frame. So how we label them is this. We label these small waves 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Finally, 1, 2, 3, 4, 5. And how we label this big impulse wave? You know that. This is 1, this is 2, this is 3, this is 4, this is 5, right? So this is how we read it is 1, 2, 3, 4, 5 for 1, 2, 1, 2, 3, 4, 5 for 3, 4, 1, 2, 3, 4, 5 for 5. This is a complete impulse wave here, right? So in most markets, this is what you see in an impulse wave. Wave 1, which is usually not subdivided into 5 waves, then wave 2, then wave 3 is clearly subdivided into 5 waves, then wave 4, and then wave 5. But this is not the rule, guys. Sometimes all of these 3 motive waves, waves 1, 3, and 5, can be clearly subdivided into 5 waves, okay? Sometimes only wave 3 and wave 5 can be subdivided, and sometimes maybe wave 1 and wave 5 are clearly subdivided, and wave 3 looks like a singular price move, okay? And how we read it? We read it, if this third wave is clearly subdivided into 5 waves, we read this wave like this. 1, 2, 1, 2, 3, 4, 5 for 3, 4, 5. Again, 1, 2, 1, 2, 3, 4, 5 for 3, 4, 5. Okay, this is how we read it. So now that you know what the fractals are, how the impulse wave on smaller time frames in more detail looks like, let's have a look at some real-time examples on price charts. This is a price chart of Forex currency pair US dollar versus Japanese yen. This is weekly time frame. So I wanted to show you an example with more than one motive wave that are subdivided into 5 clear waves. Okay, so from this bottom, this is weekly time frame, by the way. So from this bottom, which formed in October 2011, you can see that we have a move up, a move down, a move up, a move down, and a move up, and a move down, and a move up, and a move down, then up, down, up, down, up, right? So this top formed in May 2015, right? This big move, which to the people who do not know about the Elliott wave principle, is just a simple bullish trend with some ups and downs. And maybe most of these people who are unaware of the Elliott wave principle, they try to sell here, got lost, sell here, got lost, sell here, got lost, when finally the trend was reversed in 2015. So anyway, from here, we can label this. First of all, let's label this big structure. The big structure here is 1, 2, 3, 4, and 5. Okay, this is the big structure. Wave 1, 2, 3, 4, 5. Now you can see in this third wave, there are clear 5 subdivisions. Let's label them. Wave 1 of 3, 2 of 3, 4 of 3, 3 of 3, 4 of 3, and wave 5 of 3. So this is 1, 2, 3, 4, 5 for 3. Now you can also see 5 clear subwaves in wave 5. Let's label that 1, 2, 3, 4, and 5, right? So we have 1, 2, 3, 4, 5 for 3, 4, 1, 2, 3, 4, 5 for 5, right? On a bigger structure, we have 1, 2, 3, 4, 5, right? How clear this impulse wave is. This is very detailed impulse wave, very clear. All you need is just count to 5, right? 1, 2, 3, 4, 5. Do not confuse with these subdivisions. They are just 5 waves inside this third wave. These are 5 waves inside this 5th wave, right? These are just the subdivisions of these motive waves. 1, 2, 1, 2, 3, 4, 5 for 3, 4, 1, 2, 3, 4, 5 for 5, right? So this was the Forex currency pair, US dollar, Japanese yen, one of the most traded Forex currency pair in the world. This was weekly time frame. Now let's have a look on another example. This is a price chart of gold. This is intraday time frame, only 30 minutes chart, right? We are having a look at this decline that started on 9th of March 2020 and ended on 16th of March 2020. Let's see what we have here. We have a down move until we saw a significant up move. Then we have a down move. Then we have an up move. Then we have a down move. Then we have an up move. Then a down move. Then an up move. Then final down move. Right? So this is bearish market. This is intraday time frame. How we label them? 1, 2, 3, 4, 5. And the subdivisions of this third wave, how we label them? Like this. 1, 2, 3, 4, 5. Right? So 1, 2, 1, 2, 3, 4, 5 for 3, 4, 5. Clear 5 waves with clear 5 subdivisions in the third wave in the price chart of gold on 30 minutes time frame. How amazing this is, right? Now let's have a look on another example. This is a price chart of crude oil. The time frame is weekly, and this is again an example of a bearish market. From this top in May 2011, we can see clear 5 waves. 1, 2, 3, 4, 5. Do not confuse with this endpoint instead of this. We will discuss it later. Okay. This downtrend started from May 2011, ended in April 2020. Okay. So
These are clear 5 waves to the downside, right? 1, 2, 3, 4, 5. What is amazing is this subdivisions of the third wave. 1, 2, 3, 4, 5, right? What is further interesting is these subdivisions in the fifth wave. 1, 2, 3, 4, 5. So how do we label them? Is this. Let's label this small wave first. 1, 2, 3, 4, 5. Let's label the big wave now. 1, 2, 3, 4, 5. Let's label this mega wave now. So this is wave 1, 2, 3, 4, 5. Right? So you can clearly see here wave 1, 2, 1, 2, 3, 4, 5 for 3, 4, and 5. Right? And even this wave 5 of wave 3 is clearly subdivided into 5 waves, right? This is the beauty of the Elliott wave principle. You will see all these fractals and waves on every market and on every instrument and every chart, right? And they're same. So fractals are very important part of the Elliott wave principle, since only by using the fractals we can label our charts correctly. That concludes this lecture on fractals. Thanks for the attendance. See you in the next lecture.